Hello, and welcome to the 2026 Property Market Update for Western Australia. I'm Angus Moore, I'm the Executive Manager for Economics here at REA Group, and I'll be taking you through a bit of a high-level overview of what we're seeing in housing markets and the economic conditions that are underpinning that. To that end, I'm going to start with that economic backdrop to kind of set the scene for where housing markets are at. We'll then move into talking about established housing markets, focusing on what we're seeing in home prices, but also talking a bit about what we're seeing in activity across Perth as well. I'll then move into talking about rental markets for a couple of reasons. One, rental markets are very interesting in their own right at the moment, but also because of what that's meaning for one of the kind of biggest themes we've been seeing in property markets over the past couple of years, which is investor activity. I'll then wrap up with a few themes that I think are going to be interesting to watch over 2026 and potentially beyond. So with that, let's get started with economic conditions. And here in 2026, there's kind of nowhere to start when I'm talking about economic conditions other than inflation. So this chart here shows what we call underlying inflation. This is the way the RBA prefers to look at inflation, and it strips out the sort of temporary one-off things that matter for inflation, but don't really matter for thinking about the sort of trajectory of where inflation is headed. So think, transitory things like electricity subsidies or, changes in fuel prices. What you'll note from this chart and what you can see happen to inflation is that huge spike that we got coming out of the pandemic. That was why we saw the RBA responding as much as they did with those rapid and successive rate rises through 2022 and into 2023. But if you come forward to 2025, the sort of second thing you'll note from the chart is that we actually got back down inside the RBA's 2 to 3% target band. But that was pretty short-lived, and actually we've moved back above the target band. And in red, the RBA is forecasting that that's going to remain true. Inflation is actually expected to go a bit higher from here on their forecasts, and it won't be for about 18 months until we get back inside the RBA's target band. That picture there is kind of all you need to know for why we've already seen a hike in 2026 and why, as we'll talk about in a moment, more are expected. The RBA is laser focused on inflation, and so it being too high and headed in the wrong direction is why they've felt they need to respond. What that's meant for mortgage rates is, perhaps unsurprisingly, they're headed up and expected to continue to do so. So this chart here is showing the average mortgage rate for a new owner-occupier borrower. So that is if you were, new owner-occupier and you went to a bank to take out a new loan, on average, what rate are you getting? You can see that through 2025, rates came down off their 2024 peak on the back of those rate cuts that we saw last year, but that's already partly been reversed. And we are expecting that there'll be at least another one, and there's about a 40 to 50% chance of a second one currently expected by markets. That means mortgage rates are expected to, on that sort of 40 to 50% chance, get a little bit lower than where they were last year because that extra hike is not fully priced in as yet, but still going to largely reverse the cuts that we saw last year. Now, we spoke about inflation. Inflation is obviously kind of the key thing that's driving this, but it isn't the only thing that's driving it. The other factor that's driving the case for hikes, and part of why we saw a hike in February, is that unemployment is still very, very low. And that's what this chart here shows. So this is just showing the unemployment rate in purple over the past sort of 5 decades or so. What you can see is at the moment, at sort of low fours, unemployment is extremely low by historical standards. It's not the lowest it's ever been. Coming out of the pandemic was even lower again, but it is still at very, very low levels. And that's more or less expected to continue. You can see the RBA forecast there is expecting it to continue to drift up a bit, as it has been for the past sort of few years, but still remain, even by the end of their forecast horizon, at relatively low levels compared to what has been true historically. And importantly, probably still around or even a little bit below what the RBA would consider neutral. Now, that neutral it's a bit of a slippery concept and it's a bit hard to pin down, but the sort of idea is that there's a level of unemployment at which is consistent with inflation being stable and within the RBA's target band. If unemployment's too low, that puts pressure on wages, puts pressure on prices, and that pushes inflation up. So, unemployment being quite low, inflation being above the target band, suggests that, that unemployment rate is below neutral and kind of makes the case for a rate hike. Perhaps the more interesting question, though, is why? Why is unemployment so low, and why, if you kind of really zoom in on 2025 there, why did we actually see unemployment come down towards the end of last year? Well, part of the story is consumer spending, which is what this chart here is showing. This is just consumer spending relative to the end of 2019. You can see that big fall that we have there during the pandemic. Everything's shut in lockdowns. People weren't spending money. Not a surprise. You can then see as things reopen, both borders and the economy, you can see that big surge back up in spending. But then if you kind of move forward to sort of late 2023 and then through 2024, consumer spending sort of mostly tracks sideways. And this is in a period during which population growth is really quite strong. And so the fact that we're seeing pretty sluggish spending growth through that period is all the more remarkable. It means that spending per person or per capita is even softer. If we then move forward to 2025, you can see that actually, again, spending starting to pick back up, particularly towards the end of the year. And this is actually a period in which population growth has come back down to more normal pace compared to what it was in 2023, 24. So on a per capita basis, it looks kind of even firmer again. So, this is sort of pointing towards consumer demand, potentially on the back of the rate cuts that we saw last year. Another way to see that sort of same story, or perhaps more complicated way to see it, is this chart here. And what this shows is how different types of spending in the economy are contributing to economic growth. So in red is showing how private sector spending, so that's businesses and households, is contributing to growth. And in the light blue is showing how the government, so public sector spending, is contributing to growth. And if we focus in on 2024-25, you can see in 24, private sector spending, those red bars, is very, very small, meaning they're not making a big contribution to growth over this period. Consumer spending, as we talked about, was fairly weak, as was business investment. So it's a period in which private sector spending it isn't going backwards, but isn't contributing a lot to economic growth. While in contrast, public sector spending, those light blue bars, are quite big. So we are seeing quite big contributions from government, from public sector government spending. And this is, state government infrastructure projects, but it's also things like the NDIS. But then as we get into 2025, that story starts to flip. We're not seeing the same growth in government spending that we were, and we are starting to see quite large contributions from that red private sector. And that's that consumer spending we were talking about before, but it's also business investment. And so this private sector demand is part of what's contributing to inflation. It's something that the RBA called out as being surprisingly strong and part of why they raised rates in February. I'm going to move away from pure economics now and talk a little bit closer to home with housing. I'm going to start with population because that's obviously a core thing that drives housing demand, and particularly so at the moment in WA, as you can see from the chart on the left. So the chart on the left is showing annual population growth for the country in purple and for WA specifically in the orange. A couple of things that you'll note from this chart. One, WA has been growing extraordinarily strongly in recent years. That's been true nationally as well, though that pace of growth has come down for reasons we'll talk about in a moment. But two, WA has far exceeded the rest of the country in recent years. And the reason for that is the chart on the right, which we'll move to now. So the chart on the right breaks down that population growth into what's causing it. So in the light blue, we have what we call net overseas migration. So that is people moving in to WA from overseas, less people leaving WA for overseas. You can see the big contribution that we saw post borders reopening. This was a function of the fact that borders had been closed. And so during 22, 23, and to some extent 24, while we had plenty of people coming in, there was almost no one leaving because no one had arrived during the COVID era, and so their visa, we didn't have people's visas expiring and them leaving the country. That meant the net in less out was very, very strong. That adjustment period is mostly over now. 4 years post reopening here in 2026, there are plenty of people leaving the country now as their visas expire after having arrived in 22 or 23. And so that net overseas is coming back to a more typical, more balanced pace, though it is still relatively strong in WA. But the more interesting in many ways, and perhaps more recent development is interstate migration. And that's the red bars here. So the red bars show you if they're above the grey, more people are moving to WA than are leaving it. And if they're below the grey, they're detracting. That is, more people are leaving WA for other states than moving into it. And you can see kind of the mining boom back in the late 2000s, followed by the period after the mining boom, where lots of people left WA for other states. That flipped around during the pandemic, and we've been seeing really quite strong inflows from other states to WA. It has perhaps been not as strong over the last couple, 6 months to a year as it was during the sort of pandemic and immediate years afterwards, but it remains quite strong and is a big part of what's driving population growth in WA and what's driving housing demand. And just to dig in that a bit further, where we see this internal migration happening is disproportionately towards the north and the south, the more affordable parts of the cities. In fact, if we look at the inner city, more people move out of inner city Perth for other parts of Australia than move from other parts of Australia to the inner city. Now, that's not unique to Perth. We see that in that pattern across all of our capital cities. And it's not to say that those parts of the city are losing population, as the chart on the right shows they aren't. Total population growth is still positive in those inner city areas because of net overseas migration and because of births. But that internal migration, which can be quite important for thinking about housing demand, because when people move is often when they're looking to buy homes, does tend to favour those more outlying growth areas that, as we'll see in a moment, have been performing quite well. Well, that's a nice bridge into talking about housing and home prices. So let's do exactly that. Chart here is showing what's happened to home prices over the past sort of 6 years or so. And the key thing you'll note is that they have absolutely skyrocketed. Prices in Perth and WA are up 120% over the past 6 years. Or to put it another way, they are more than twice what they were before the pandemic started. Now, that's not unique to Perth. Brisbane, you can see on the right there, Adelaide, fairly similar to Brisbane, have also seen pretty similar pace of growth. But it is very different from what we've been seeing in Sydney and especially Melbourne, where you can see that price growth has been much more sluggish over this period. 2025 kind of continued that story. Perth was still up very strongly across 2025. Prices were up about 17% across Perth, which is still very strong growth. So we really haven't seen much of a slowdown, despite the fact that prices have doubled and affordability has become a lot more challenging. Digging into Perth a little bit more detail, we haven't seen a lot of difference between the performance for detached houses in the pink here and for higher density units over the last sort of 4 years, but we did during the pandemic. You can see that gap in performance between houses and units really opens up sort of 2021 and into 2022. That was not unique to Perth. We saw this in pretty much all of the country. But then since then, these two have largely moved together. What that means is houses are up more than units, though they do make up a very large share of the housing stock in Perth. But we haven't seen radically different performance over recent years. What we have seen, or where we have seen a little bit of a difference, and I do want to stress that it's only a little, it's not a huge divergence, and we have seen bigger divergences in some other cities, is that the more affordable end of the market has done a little bit better in recent years. And that's consistent with the very challenging level of housing affordability that we're facing at the moment, and people looking in, and looking for those more affordable homes and that supporting price growth in those areas. Again, that's not a unique story to Perth. We have seen that in other parts of the country as well. Though, I don't want to put too fine a point on this one. The gap that you can see here is not huge between the, sort of most affordable segment in the light blue, between the sort of middle market in purple and the top end in red. There are some gaps there, but they're not huge. Similarly, outer suburban markets, which again tend to be a bit more affordable, have generally been a bit stronger in the past year. Though again, I don't want to put too fine a point on this. Growth's been pretty solid across most of Perth. You can see, the gap between the sort of best performing and slowest growing is still pretty narrow, and everything's up double digit over the past 12 months or so. So again, it's not really a story of big divergences in growth, which is different from what we had been seeing during, say, the pandemic, when we did see some bigger divergences in growth across the city. At the moment, it's really a story of fairly consistent growth across Perth. Moving away from home prices now and talking a little bit more about, what we're seeing in terms of activity. The price growth over the past sort of 12 months or so has been supported by the fact it's been pretty limited supply. We haven't seen a lot of choice for buyers. There hasn't been a lot of new listings hitting market. That's made it competitive, and that's probably, at least at the margins, been supporting home price growth across Perth. So this chart here is kind of how I like to look at listings. Listings are very seasonal. Obviously, very few people list in December. October's very busy. So you want to be comparing month for month. And so that's what this allows you to do. You can follow each color, which represents a year, and then compare each month of each year. What you can see is that 2025 started around average, so relatively similar to the black line, but then from around about late winter, August, and then right through spring was fairly quiet and below what is typical for that time of year in the black line, and certainly a lot quieter than we saw in 2024 in the red line there. It's also worth noting, that black line is the average over, the sort of prior decade, which includes COVID, and there were some quiet years and also some busy years in there. So that average is maybe a little bit skewed, but nonetheless, it has been a fairly quiet year in 2025, and that's probably at least partly been supporting home prices. All right. I'm going to take a little bit of a detour now and talk about what we're seeing in rental markets. Rental markets have been very challenging, and that remains the case. The story here is really that availability has improved a little, but remains very, very tight. And I think the best way, and where I always like to start when thinking about rental markets, is the rental vacancy rate, which is what this chart here shows. And so that just measures the number of rentals that at any given point in time were vacant and available for someone to move into, as at the end of the relevant month, as a share of the total number of rentals. You can see for Perth in the blue there, or for regional WA in the green. At the moment, rental vacancy is around 1 to 1.5%, depending on the month you're looking at, whether you're looking at Perth or regional WA. Very, very low. That's much lower than what we would consider sort of more typical, which is more like 2 to 2.5%. You can see, prior to the pandemic, rental markets are actually pretty soft in WA, consistent with a pretty soft housing market broadly out west during that period. That's been the case for a while. We've been seeing very limited availability in much of the country, but in Perth especially, since kind of 2021, maybe early 2022. The rental vacancy rate is obviously very volatile month to month because it depends on when people move and how many people are moving rentals. But so you have to look through the trend a little bit, and the trend is broadly that we're not quite as tight today as we were in sort of late 22 or through 2023 in Perth, and similarly regionally, though regionally was maybe a bit tighter a bit earlier. And that's consistent with what we're going to see in rents as well. Rents are still growing. So the chart here is showing median advertised rents for houses in pink, for units in purple. Rents are still growing and still growing relatively solidly. Rents are up 7.5% over the past year in Perth, which is, certainly much faster than what we'd consider typical. There's not necessarily a right number for rent growth, but 2.5% kind of consistent with the RBA's target band. It's a reasonable sort of baseline to start from. It's certainly Perth's, a bit unique relative to other cities in that it was actually seeing rents fall through the 2010s, consistent with, population outflows and relatively soft housing markets during that period. So we are still seeing, strong, brisk growth in rents consistent with that relatively limited availability. The good news for renters, though, is, consistent with that availability maybe having improved a little bit compared to what we were seeing in 2022 and 2023. Rent growth today, while still pretty strong, just isn't as fast as we were seeing in 2022 and 23. We were seeing, nearly 20% growth at some points through there. And while growth is still strong today, it's nothing like what we were seeing there. This is not unique to Perth. We see this story in other parts of the country as well. Rents are still growing relatively solidly, but not as much as what we were seeing a couple of years ago. Rental vacancy is still very, very low. Availability is low, but it's maybe a little bit improved from what we were seeing, 2 or 3 years ago. What that is translating into, tight rental market conditions, rapid growth in rents, is quite a lot of investor activity at the moment. So this chart here is showing the number of new investor loans each quarter in WA, which is a pretty good way to kind of get a proxy for investor purchases, because most, not all, but most investors will be buying with a loan. And what you can see is a pretty consistent ramp up in investor activity over the last, 6 years or so. And at the moment, at least on, the data that we do have, which, is fairly limited, number of investors buying in Perth at the moment is the highest we've ever seen. Again, this is not unique to Perth and WA. We're seeing this in most states around Australia, as we'll talk about in a moment, with big ramps over the last couple of years. Other parts of the country saw more of a fall off in investor activity sort of post-pandemic as the RBA was raising rates, in part because they saw more of a ramp during the pandemic. Perth was still seeing relatively little investor activity, as you can see sort of in 2019 and at the start of the pandemic, whereas, other states were seeing a bit more investor activity. But the sort of ramp that we've seen post-pandemic, post-rate hikes, once rates stabilized in 23, is something that we've been seeing around the country. In terms of where those investors are looking, they are disproportionately looking in more affordable parts of the city. So you can see the south here is very popular, but even, towards the sort of southeast as well is quite popular. Again, this is not unique to Perth. We see this sort of pattern of investors looking in more affordable areas kind of right around the country. Inner city areas also tend to be popular. That's not as true for Perth as perhaps it is for somewhere like Melbourne or Brisbane, where, the CBD is a really popular area for investors, consistent with those being, big, deep rental markets with, a lot of renters, a lot of rental properties. Maybe not as true in Perth as we see elsewhere. And just to wrap up on investors, I think another way to sort of make this point about how important investors are in housing markets is this chart here, which is showing the share of loans going to investors. So rather than the raw number loans, this is just the share of loans that are going to investors. And again, you can think of this as kind of a proxy for the buyer pool. It's not a perfect proxy because, not everyone buys with a loan, but it's kind of the best that we have. And on these data, at the moment, around about 40% of loans are going in WA are going to investors. In Queensland, 40%. And this is as high as we've ever seen. It's not quite a record, I've got to be careful there because everyone loves a record, but it's very close to. In New South Wales, it's up at 45%. Again, not a record. New South Wales has seen some periods with higher investor participation, but still very high relative to average. South Australia, Northern Territory, it basically is a record. It's just off. September was the record. December's just down, but still very, very high. Even Victoria, which really hadn't seen much of a pickup in investor activity for a variety of reasons, has started to see it ramping up over the last 6 months, and you can see that in that chart there. Right, I'll wrap up on investors there, and I'll move on to some of the themes that I think are going to be interesting to watch over 2026. And the first is residential construction. So the chart on the left here is showing the number of new homes nationally that we build each quarter, and then on the right for WA. In red is for detached houses, in blue is for higher density. And kind of no matter how you cut it, we're just not building at the sort of pace that we would need to hit the National Cabinet's target of 1.2 million homes over 5 years. Now, we are headed in the right direction. In some states, WA notably, we are starting to see a ramp up in construction, though that's as much a story of, the late 2010s being very quiet as it is, strength in residential construction now. But things are certainly heading in the right direction in WA. There's some evidence we're starting to see a pickup in approvals for higher density in places like New South Wales. That hasn't translated into actual building activity yet. As you can tell from the chart on the left, it does not move up. But, those approvals will eventually translate into new homes. Residential construction's been a very challenging sector for a number of years, for a few reasons. One, we saw big increases in construction costs during the pandemic and very rapid increase in construction costs. It's also been very hard to get skilled labor, and it's been taking longer to build homes, particularly for detached homes. So that's all a very, negative picture. To finish on a more positive note for the new home sector, those three trends look like they're starting to abate. They're not behind us, they're still challenges, but it does look like we're headed in the right direction. Costs are still high, they're not coming back down, but the pace of cost growth has come back to something that's more typical, more normal, more stable. And so, we're no longer in that environment of real uncertainty around costs that we were during sort of 21 and 22. And so, while it is still more expensive, I don't want to pretend that, it's suddenly become a lot cheaper and easier to build homes. we're not in that unpredictable environment for builders anymore. Unskilled labor, look, still a challenge, but there is some evidence that employment in residential construction is starting to pick up as some state government infrastructure projects wind down. And so that's starting to improve availability, at least nationally. And on build times, we saw a big increase in build times during the pandemic, and that continued into the post-pandemic period. That's finally starting to come down. Again, it's still taking longer than it was pre-pandemic, so this is not a solved problem by any means, but we are at least headed in the right direction. The second theme I want to talk about is first home buyers. And the reason for that is we saw some policy changes towards the end of last year from the federal government to support first home buyers. And those are the Australian Government 5% deposit scheme at the top and the Help to Buy scheme at the bottom. So the former is essentially LMI from the government. It allows a first home buyer to buy with a 5% deposit, but they don't have to pay for LMI. This scheme's actually existed for a while, but the change on 1 October changed the scheme to remove income eligibility thresholds. So previously you had to be under a certain income to be able to take advantage of the scheme, and also to uncap the scheme. There was previously a limit on the number of places of 50,000. That's now been removed. There is still a price cap. It's relatively high, not as high in Perth perhaps as some other parts of the country though. So it's 850,000, which for some first-time buyers will be a constraint, but for many it won't be. The Help to Buy scheme's a bit smaller, a bit newer, came into operation early December. This is a shared equity scheme, so the government kind of buys a stake in your home alongside you. This one does have income caps. It does have a limit on the number of places, so it'll probably be a smaller scheme than the 5% deposit scheme. Now, that deposit scheme only came into operation in 1 October, so we don't have a lot of time and a lot of evidence yet of its kind of impact. But we would expect this, easing of deposit constraints to bring forward some first-time buyer demand. And there's some evidence we might be seeing that already. So this chart here just shows the number of first-home buyers nationally, and you can see right at the end of the chart there's a bit of a tick up in the number of first-home buyers. And that covers, it's for the December quarter, which covers the 3 months that the scheme was in operation. Now, obviously, only coming into operation 1 October, and someone has to, apply, get approved, find a home and settle. So you wouldn't expect to see a huge impact yet because there's obviously going to be lags between that scheme and activity. But there is maybe some evidence that we're starting to see it already. I think an important theme over this year will be whether we see this continue, how big an effect this scheme has on first home buyer demand. And, to the extent that it is pulling forward first home buyer demand, as it, maybe looks like it is, that is going to affect the sorts of markets and segments that first home buyers tend to favor. And just to wrap up, I started with inflation. I'll finish with it as well. Inflation is going to be the thing to watch over 2026 for what it means for rates. And this chart is one way that I like to look at that. So in black here, I'm showing the actual RBA cash rate target and how it's changed over time. And then in the different colors is what market pricing expected the cash rate would do as at different points in recent history. So in red is late October, which is not even really that long ago. Markets were expecting basically 2 cuts to the cash rate. But then after that red line, we got the September quarter inflation data. And it showed that inflation was higher than we thought, that it looked more persistent than we thought, and so we moved up to the blue line. And then after that blue line, we got the December quarter data, and it showed, nope, actually inflation was even higher than we thought and even more persistent than we thought. And so we moved to the purple line. And where that is today is, as we spoke about at the start, we've already seen one hike, markets have priced in another, and there's about a 40 to 50% chance of a second hike by the end of the year. But the point is, one, that's the outlook for the cash rate, and two, that can all change, and it will change based on what happens with inflation. We've gone from 2 cuts to 2 and a bit hikes in the space of a pretty short period of time, just on the basis of inflation coming in stronger than expected. Now, if inflation evolves as expected, we'd probably expect to follow something like the purple line, but it could be that actually, September and December were outliers. Inflation isn't as persistent as we think, and, we may not see as many hikes. That's certainly not what the RBA is expecting, but these things are all possible. With that, I will wrap up. Thank you very much for your time. I hope you found that helpful.